Welcome to GRE. I'm your host, Keith Weinhold. The real estate BRRRR strategy is a shortcut to growing your wealth, but it's less passive than buy and hold with a property manager. Learn what is the BRRRR strategy, and then about some of its pros, cons, mistakes you must avoid, and financing programs available, and how it can generate infinite returns for you today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE. From Bridgeport, Connecticut to Bridgeport, Texas, and across 188 nations worldwide, I'm Keith Weinhold, and you're listening to Get Rich Education. Let's do good in the world and abolish the term slumlord, profiting at the same time by providing housing to others that's clean, safe, affordable, and functional. This is where, on this show, we often tell you how to become financially free through real estate investing in the next 5 to 10 years without having to be a landlord or flipper. We're going to talk about how to shorten that timeline in a moment, but I have a couple resources to share with you first. One late-breaking development at GRE Marketplace that's been popular is in Florida with new builds, brand new construction, fourplexes, duplexes, and single-family rentals with points paid a 4.25% mortgage rate. Yes, 4.25%. You can pay fewer points and still get a 4.75% rate. Also, some good low interest rate deals for foreign nationals. Go ahead and connect with a GRE Investment Coach and learn about those at GREmarketplace.com for a 4.25% mortgage rate. If you're a Spanish speaker or have Spanish-speaking friends, check out GetRichEducation.com/espanol to see my free video course on how real estate pays 5 ways in Spanish. It's pretty interesting how our team here has applied AI to show me speak it in Spanish. Again, you can see that at GetRichEducation.com/espanol. Now, the BRRRR real estate investing strategy is popular because it can reduce your out-of-pocket expense for property substantially. Let's break it down here. That is the BRRRR. There are 4 R's after the B, which stands for, the first B is buy. You buy a distressed property that needs to be fixed up. Then the R's stand for rehab, then rent, then refinance at that higher value, then repeat. More of you have been buying BRRRR property through GRE Marketplace. Yes, we help you find not just buy and hold properties here, but properties optimized for the BRRRR as well. There are properties that need some work and they are not turnkey, not ready to go. With little or no money, in less than 3 years, you can have a portfolio of 10 to 20 properties with the BRRRR strategy. That's a shortcut, but that does take some work. It's less passive. You're buying distressed property that needs to be fixed up, and you have to be sure that the contractor is getting the work done on time, on budget, and of adequate quality standards. And vetting contractors and dealing with contractors is not easy. I'm going to have a few tips to help you deal with that today. But if you get it dialed in, BRRRR lets you pursue an infinite return strategy where you buy property at a low price, renovate it, get it rented, and then refinance it at the higher value. And at times you can get all of your invested cash out on that refinance? Well, because a return on investment formula is simply your dollars returned divided by the cash that you have invested in the deal. Well, therefore, if you have no money left in the deal anymore, your return is infinite. Listen carefully. If our guest doesn't do it, then what I'll do is introduce an example here in our conversation for you to get you to help understand the BRRRR. And if this is new to you, this will stretch your thinking somewhat. And then after our break, I'm going to come back and we'll discuss more about any changes to conventional loans for buy and hold investment property. And there's one place that's created more financial freedom through real estate than any other lender in the entire nation. It's time for a big welcome back to their leader, Caeli Ridge.
Hey, Keith. Thank you for having me. It's always a pleasure to be here.
Well, you know who she is by now. She leads Ridge Lending Group. They're an investor-centric lender, and she does such a good, concise job of explaining what real estate investors need to know in optimizing your loan positions, and that's why she's here with us again. And Caeli, rather than just learn about conventional buy and hold loans or refinance loans like we've covered in the past, let's talk about lending for the BRRRR real estate investing method. BRRRR is a method for buying distressed property at a discount, so not turnkey, not fixed up property here. And BRRRR stands for buy, rehab, rent, refinance, and repeat. Now, for these loans, is the lender looking more, I guess, Caeli, maybe we should start with, are they looking at the property strength or more at the borrower strength for BRRRR loans?
Well, first of all, I would say that BRRRR is one of my favorite strategies for real estate investors, especially if they're getting into diversifying their portfolio. I think BRRRR is a very lucrative way to achieve the returns that people are after, not only in appreciation, but also in cash flow. You can get some really great leverage in these. ROI ends up being better if you find the right property. So I'm a big fan of the BRRRR. But to your question, Keith, it depends on what product they're going to elicit for the end loan, for that refinance loan. If we're talking about a conventional loan, Fannie Freddie, then the qualifications are still about the individual and their debt-to-income ratios, et cetera. If we're going to put this on a debt service coverage ratio, which it can apply to both, the strategy does not obligate them to one or the other. So we can go conventional, where it's still going to be about the individual, or we can look at more of a debt service coverage ratio, where it's about the income of the property in relation to the mortgage payment.
And before we go on, of course, identifying a deal is a key here in the BRRRR strategy. Is there any guidance you'd give with identification of that property? Because you might know more from the lender perspective on what's going to be lendable.
Well, as long as it's habitable, we can lend on it. I would say that you really want to pay close attention to a couple of things from a lender's perspective. The ARV, right? The after rehab, after repair value is the linchpin to all of this. And if you're out there getting your comps from whatever sources, the agent or Zillow or Redfin or whatever it is, the more data that you can gather, the better. But just keep in mind that the ones and zeros that you're probably gaining access to don't necessarily have the components that show all the rehab work that you're putting into it. So if you're getting a value of a property, like-kind property, in the area or vicinity that the property is located, it's not always going to attest to what extras you put in, whether it be the hardwoods or square footage or whatever it may be. Just keep in mind that you may not be on point there. And real estate agents, I would want you to have or be working with one that really understands the BRRRR method, aka investor models, to make sure that you don't get caught in a scenario where you're expecting a value of X and it comes in at Y. That can be very devastating to the BRRRR methodology, especially for new investors.
Talk to us more about coming up with the ARV, because with a conventional loan on a conforming property, that value that you're lending against is typically the appraisal.
Correct. And the appraisal is going to take into consideration those rehab pieces, but it's not dollar for dollar. And while I don't know that we want to go down the appraisal rabbit hole, I will tell you that if you've got $50,000 of rehab into the property, that doesn't necessarily mean you're going to get a full $50,000 in extra value. A lot of it has to do with what you paid for it. Like Keith, you've said at the top of the podcast here, distressed property. A lot of times when people are getting into BRRRR, they're finding under market value property to begin with that's already worth more. They're putting in some real value adds, maybe cosmetic, maybe a little bit more, and then expecting quite a bit more in value. So there's definitely a science to it, but just make sure that for all intents and purposes, you're gathering as much data as you can, and the agent, if you're using a real estate agent to help with MLS listings, et cetera, that they have some basis of background within this particular philosophy.
Okay, so we are projecting an ARV, an after repair value here, and then we need to lend against a percentage of a certain value. So, Caeli, since in this case the property is distressed, well then if the property is the lender's collateral, and that collateral is a little, why don't we call it damaged, if you will, well then I'm going to speculate that is that lender probably not going to give you as favorable loan terms as they would on a conforming property. So tell us more about how those BRRRR loan terms look.
So you might be surprised. Again, as long as the property is habitable, the LTV is going to be the same. The value of the property is probably what you're going to notice more than what the lending side is going to allow for in the loan to value. So on a single family residence, if it's habitable, we're going to give the individual up to 75% of that ARV.
Good.
Now, I don't know if we're ready to go down this road. I think we should talk about it at some point. The ARV and how we want to maximize and not leave any money on the table. We want to discuss the purchase price and the acquisition. I think we'll come to that. But to answer your question, habitable, 75% single family or 70% on a 2 to 4 unit is going to be the maximum loan to value using the appraisal when we talk about a cash out refinance of an investment property, which may be different if we get into a rate and term refinance as a purpose of BRRRR, which we'll probably touch on as well.
Well, I think for the listener benefit here, maybe it's good to jump into an example. If you want to apply some real numbers here to a BRRRR deal, and then let's walk through that with the financing and more.
Let's start with cash out because it is different than a rate and term. So cash out, simply to clarify, means that the individual is going to get cash in hand. We are not simply paying off an existing hard money loan. That is a rate and term refinance. So we want to start with cash out, where the cash to acquire the property was the individual's sourced and seasoned funds. And let's assume that the scenario looks like this. They paid $100,000 for the property, and then there's $50,000 in renovation with the expectation, or let's just say that we get an appraisal for $200,000. So at $200,000, and it's a single family residence, 75% of that is $150,000. Okay, so that pretty much covers their total acquisition cost. But then we've got
a price and renovation cost is covered,
right? Covered, but we have to count for closing costs, tax, and insurance. Let's just make it around 10 grand. So the individual is going to end up with $140,000 from their $150 total acquisition cost. If you divide those two numbers, you're probably going to be at what? So 140 divided by 150,000. Yeah, 93% overall leverage. You've got 10 grand skin in the game. And when you look at it from that perspective, 93% overall loan to value or leverage of this property is very, very high. If you can get a deal to work like that, you're doing very well.
And you can see why people like this and why people are attracted to this. So yeah, go ahead and tell us more about this, because really when we talk about lending for a BRRRR property, we're probably talking about two different loans, right? We're talking about the purchase price up front and then the refinancing later on.
Right. So going back to my example, if you paid cash for the property, if that $150,000 was your sourced and seasoned funds, and if you want, Keith, tell me later and I'll go into what sourced and seasoned is, but you have $150,000 in on this property. The key to getting up to the maximum of $150 back, or in our example, you ended up with $140 back because we accounted for 10 grand in closing costs, is to make sure, and this is wildly important, and a lot of people get this wrong the first time they go down the BRRRR road, make sure both the purchase price and the acquisition costs are listed on your final CD, aka closing disclosure. A closing disclosure comes to you at closing, where it's a document, a form that illustrates all of the line item pluses and minuses of the buyer and the seller and what everybody netted at the end. The CD must have the total 150 listed on there, and just one number is fine. It can be broken up into two numbers, whatever, but as long as both numbers are listed on the CD, you, as the borrower, our client, per guidelines, are eligible to get up to that much back. So the guideline states that the individual cash in hand cannot exceed a maximum of what the total acquisition cost listed on that CD is. So what the common mistake is, let's just keep using our $100,000 purchase and our $50,000 renovation. The common mistake that people make is that they pay the $100,000, the seller is made whole, and then the day after closing, they are officially now the owner of this property. They send the $50,000 out to the contractor. Seems obvious, right? Well, in doing it that way, you've left $50,000 on the table, and now you're going to have to wait 12 months per new guidelines to have 12 months of ownership, seasoned ownership per Fannie Freddie, to get the total 150. So make sure that the total 150 is on that CD. And the way to do this, just one more little detail, you want to be working with an escrow company that provides something called an escrow holdback. Because a lot of times when I give this advice, people say, well, I don't really want to release $50,000 to the contractor before they've even started any of the work, right? That makes sense to me. And most escrow companies do this. An escrow holdback says that the $100,000 goes to the seller. The $50,000 is earmarked for the general contractor. You've gotten your bids, etc. But the escrow company will then deliver the $50,000 upon your approval as draws to the contractor as work is being completed. And that kind of absolves that extra layer of risk. But now you've done the appropriate thing for the financing to maximize your cash out, and you're not leaving yourself in a weird position to front load $50,000 before, they've even started on whatever repairs there are.
Yes. How much motivation does every contractor have if they've already got their $50K for $50K worth of work before they do the work? And it works this way a lot in the contracting world, where progress payments are made intermittently as the contractor performs their work. So tell us more about what we need to know here, Caeli, especially when it comes to the BRRRR and loans, because you just gave us a great mistake to avoid there.
Kind of keeping on that theme, and then let's talk about a rate and term refinance. Some of the pushback that I'll get when I have these conversations, well, you get your bids. Okay, we'll start talking about the $50,000 in renovation, for our example, and you probably get a low and a high and middle. Maybe you go with the middle. It's been my experience personally, and just through conversations, that the bid is $50,000. If you don't have the upfront conversation to say, I'm not going to pay a cent over the $50,000, and or you negotiate to say, okay, what is our variant here? Because a lot of times the contractor is not going to be pigeonholed to $50,000. They're going to come back and say, no, I'm not going to sign anything that says that it will not exceed $50,000. There are costs of things that are out of my control, blah, blah, blah. Right. Then coming up with, okay, fine, $55,000, $52,000, whatever that margin might be, including that in there, and then having the conversation that says, okay, fine, because you don't want to leave that money on the table. So let me take a step back. $50,000 becomes $55,000. And if you didn't have it on the CD, that $5,000 is not eligible to get back. So if you increase the amount that's on that CD per the conversation with your contractor, make sure one of two things, that if it isn't spent, that it's coming back to you. And assuming if it is, then everybody is on the same page and it's just going to be part of the expense and part of what you have potential to get back. So just food for thought there. Then moving into the rate and term refinance. Now, this is something totally different. This means that you went out and got a hard money loan, some kind of a private bridge loan, which, by the way, Ridge does. We have bridge loans that can help fund the purchase and the renovation. We can talk about that if you like. But if you went out and got a hard money loan, this is no longer a cash out refinance unless the value is so high that based on a 75% LTV for cash out, that there's enough money on the table that you don't want to wait the 12 months. I'm going to pause on that for a second and just say that the numbers work for a rate and term refinance where we have an existing loan. Let's say you got a hard money loan for $150,000. A rate and term refinance lets us go to 80% loan to value on a single family, 75 on a 2 to 4. If you recall, a minute ago, it was 75 and 70. That's cash out refi rules. Rate and term refinance rules, when you're not getting any money in hand, we're simply paying off existing liens plus closing costs. They increase the LTV allowances. So 75 2 to 4, 80% on a single family residence. So if we can go 80% on the 200,000, what is that? I can't do mental math, Keith. So 80% of 200,000 is 160. So in that case, think about this. So let's just keep going back to our example. You've got 150 into it. We've got 10,000 of closing costs. Okay. 150 is a hard money loan that we have to pay off. And the 10,000 is what the new refinance closing costs are going to be. The value came in at 200,000. 80% of that is 160,000. That's no skin in the game. You have completely covered the hard money loan, paid for the closing costs. I mean, you can't get better than that. That's 100% leverage, right? You're not getting cash back. Now let's take that and say that the value came in at 250, and that's a lot of money. In that case, you may want to wait for the 12 months to get that cash back because you're going to be limited. If you use leverage to acquire the property versus your own cash, that's when you're going to have to wait that 12 months. Or if your cash acquisition, the numbers work out where you'd get an exponentially more amount than what you put into it, you may want to wait there too. It really just depends on what that ARV is going to be. That's why it's the linchpin that'll make you decide whether you're going to wait the 12 months or if you're ready to rock in the immediate terms with a rate and term refi, no seasoning. If you're not getting cash back, I don't care. We can do it immediately. or a cash out refinance, as long as you're not getting more back than what you paid for it, and we can show that the dollars to acquire all in the CD and they came from you, no seasoning.
All right, so it's the BRRRR strategy with the cash out refinance, and then the BRRRR strategy with the rate and terms there, if you will. Is there anything else that we need to know about either one of those, Caeli?
A lot of people always want to say, well, what are the rate differences? And I would say that, overall, they're going to be roughly the same. When we start talking about those LLPAs, again, Keith, loan level price adjustments, they're pluses and minuses that have to do with risk. A cash out is a higher risk than a rate and term. A rate and term at 80% versus a cash out at 75% might offset that. So relatively speaking, they're probably going to be within an eighth to a quarter percentage point if all the other variables are equal.
Now, Caeli, I think of a hard money loan as something that allows you to put both the purchase price of a property and the projected rehab cost and roll those all into the loan at closing. That's what I think of as a hard money loan. Is there any difference between a hard money loan and the other things that you're describing to us?
Not really. I mean, it's probably a cat of a different name, right? I mean, a hard money loan, a private money loan, a portfolio loan, a bridge loan. I mean, you could use the same thing depending on the context of the sentence to mean the same thing, maybe something different. You're probably right. In this context, it's going to be the same, I think.
Well, I want to talk to you more about conventional loans and any mortgage industry trends that have been taking place lately. But before we do you have any last thing to tell us about the BRRRR strategy, where really someone can accumulate maybe 10 or 20 properties in just 3 years with little or no money, but more work?
Yeah, a little bit more work. I would say get to know your market, have your team. That contractor, man, I think you alluded to this. I think that's the piece that most people struggle with, is finding the right contractor. One of the things that tends to work well if you have established a relationship is kind of getting in with some kind of a JV with the contractor, right? They've got skin in the game. Maybe if your numbers work out, they get a 5% bonus on the end, whatever, just to kind of not keep them honest, but keep them honest, if you know what I mean. So making sure you've got a good contractor that you can trust. If you're going to be doing this out of state from where you live, even more so, doubly so, you really want to have the right team. And that includes the general contractor, the escrow company, your lender. Everybody's got to kind of be on the same page if you're going to continue to do this as a rinse and repeat. And then finally, I would say, bring it to Ridge. Let's just make sure, if you're new to doing this, I want to make sure you're not leaving that money on the table, that we're structuring it appropriately so that we're maximizing the loan to value, we're maximizing your dollar, and that you're not leaving money for some period of time longer than what you would have wanted to, because this is a rinse and repeat, right? If you don't do it right the first time, you could be stuck tying up 30 grand for 12 months that you would have otherwise been able to capitalize on if we looked at it in advance of you pulling a trigger.
Yeah, that's correct. In fact, that last R in the BRRRR strategy is to repeat it. And yeah, to your point about contractors, I like to think about what contractor motivations are and what my motivations are. And at times, I have incentivized contractors with giving them a 5% bonus if they finish things ahead of schedule, or a 5% penalty if they finish things behind schedule, and putting that in the contract as well. You're listening to Get Rich Education. We're talking with Ridge Lending Group President Caeli Ridge about getting loans for the BRRRR strategy. More when we come back. I'm your host, Keith Weinhold. For a lender that's a specific expert with income property, you need Ridge Lending Group, NMLS 42056. In GRE history, from beginners to veterans, they provided our listeners with more mortgages than anyone. It's where I get my own loans for single-family rentals up to 4 plexes. Start your pre-qualification and chat with President Caeli Ridge personally. They'll even customize a plan tailored to you for growing your portfolio. Start at ridgelendinggroup.com, ridgelendinggroup.com. I'll just tell you, for the most passive part of my real estate investing, personally, I put my own dollars with Freedom Family Investments because their funds pay me a stream of regular cash flow, and returns are better than a bank savings account, up to 12%. Their minimums are as low as $25K. You don't even need to be accredited for some of them. It's all backed by real estate, and I kind of love how the tax benefit of doing this can offset capital gains and your W-2 job's income. And they've always given me exactly their stated return, paid on time. So it's steady income, no surprises, while I'm sleeping or just doing the things I love. For a little insider tip, I've invested in their Power Fund. To get going on that, text FAMILY to 66866. Oh, and this isn't a solicitation. If you want to invest where I do, just go ahead and text family to 66866.
This is our Rich Dad, Poor Dad author, Robert Kiyosaki. Listen to Get Rich Education with Keith Weinhold. Don't quit your daydream.
Hey, welcome back. You're inside episode 502 of GRE. I'm your host, Keith Weinhold. We're talking with the president of Ridge Lending Group, Caeli Ridge. She talked to us before the break about BRRRR financing strategies and the things that you need to keep in mind in order to optimize your returns there. And Caeli, now back here on the conventional side, we talk more about conforming loans for properties that are already fixed up, or maybe people call those turnkey. What about some of those hurdles that investors often have in there? For example, I know that the DTI, one exceeding their debt to income ratio threshold when they try to qualify, is sometimes a problem. So can you talk to us about some strategies with that? For example, sometimes a person might have a $500 a month car payment, but they only have 4 more payments to make for their $2,000 principal balance, and it just makes more sense to pay that off, and then that drops off the DTI calculation. Are there any other thoughts you have with regard to that?
There's so many. And this, I mean, we probably have our own episode for all different ways on debt to income ratio and to move that needle. Just to go back to your example, just FYI, if the car loan is financed, not leased, and there are 10 months or left reporting on the credit report, automatically per guideline, we can exclude that. If it was a leased with 10 months or less, we have to keep it in the ratio. But if it's a finance car, 10 months or left are showing on the report, it's automatically reduced from the liability section of DTI. The other things that we're going to look at, just obvious things, can we gross up any kind of income, right? Are there bonuses or commissions or Social Security or veterans benefits or whatever that allow us to gross those up? Making sure that we've got all of the applicable income that they gather. Sometimes people will forget to say, oh, well, I get this, child support or alimony or whatever it may be that I didn't think to disclose. We want to make sure that we have that in there. And then when we talk about liabilities, we want to look at, here's kind of a good one, student loans. Let's say that either co-signed or you have your own student loans. Fannie and Freddie have different, and maybe they're in deferment. Okay, so when we pull the credit, it shows 0 as the monthly payment. Well, Fannie and Freddie have different rules about what we have to hit them for. And I could be getting these backwards, but I think that Fannie is 1% of the outstanding balance, whereas Freddie is 0.5%. So depending on some other variables, we may elect to say, okay, DTI is really tight. We're going to take this and make this one a Freddie, assuming that they fit all the other boxes, so that we're only having to hit them for that 0.5%. Otherwise, we look at maybe paying off revolving debt, get those payments down. If they're small enough, maybe there's a $3,000 balance that has a $300 payment that's really screwing things up and they can afford to pay that off. So certainly we can look at those kinds of things, adding in a co-borrower, putting more money down, buying the interest rate down, maybe finding slightly cheaper insurance, right? At least for the purpose of the loan. And then if you wanted to get higher insurance or lower deductibles later or higher deductibles later, you could certainly do that. So there's so many different variables that we can look at to really, it's not a one size fits all. And DTI is kind of a slippery slope. And there's lots of different ways in which we can get that down into check. And if it doesn't happen today, we can help them plant the seeds for what to do tomorrow and making sure that we get them there.
Wow, that was fantastic. I hope you, the listener, are listening closely because Caeli just gave so much packed, nutrient-dense information about what you can do with your DTI. And for starters, I think a lot of people think about reducing their debt to improve their DTI, but is all your income being credited as well? Hopefully you caught that part when Caeli said that. But when it does come to reducing the debt portion, of course, student loans have very much been in the news with all these plans for forgiveness. Is that impacting DTI substantially?
If they have the right documentation, sure. Yeah, if they're on there and we have the right documentation that shows that they are forgiven, but they just haven't caught up with the system, then absolutely. Otherwise, if they don't have the supporting doc, the letter that says, and it's on the credit report, we're going to have to hit them for it, whether there's a payment there or a 0 deferred, and then we have to figure out the 5.5 or the 1%. It'll have to be in there. It just depends on what they can deliver in terms of that forgiveness in paper trail.
Now, you deal with mortgages every day in there. That's what you specialize in for investors. Are there any just overall mortgage industry trends that really specifically impact real estate investors that have occurred or are imminent?
The rates. Everything is going to come back to the rates. As much as I impress upon people, it really shouldn't be about the rate. And I understand the psychology. Listen, but if they're not doing the math, they're really doing themselves and their future investment a disservice. The shelf life, you guys, of an investment property mortgage is 5 years. whatever the rates are today, you're not going to have that interest rate almost certainly in 5 to 7 years. So kind of looking down the forecast of where rates we think they're going to go, the appreciation of the property, harvesting equity, pulling cash out, keep those things in mind when you fixate on the interest rates. I would say that that's usually what is top of people's minds. The most recent inflationary data came out. It was hotter than we expected. However, shortly thereafter, if you're watching closely, the unemployment rate and the jobs report, I think it offered 175,000 new jobs, and the projected was 2 something. So that's good news. And listen, you guys, you can't have it both ways. We're in a hot economy. I guess it depends on who you're talking to and who you're asking. I understand. But for all intents and purposes, we've got inflation is down. It's not down where the Feds wanted that 2%. The unemployment rate is very, very low. So in that regard, we're doing very well. So interest rates are going to be higher. Unfortunately, it balances this way. The worse the economy does, the better the interest rates do. Finding that equal balance, I think, is the key. And don't ask me. I'm not going to try and predict how to do that. But do your math. Be prepared for refinancing when it comes. Sitting on the fence is usually not going to be to your advantage. If you're waiting for interest rates to come down, and that coupled with house values come down a little bit too, then you may have played yourself out of the refinance anyway for the purposes that you wanted to pull cash out. So just be educated, call us. We can kind of walk you through some of that stuff. Interest rates, I think, are going to be higher for longer unless we see some real significant data trends, because there's a lag in what we get from the Feds. And I think they try to put that in there, but who knows what's going to happen? When are they going to see us again? June, July, we'll see what happens. If jobs reports keep being light, then maybe we start to see a little bit more reprieve in the interest rates. But we're what, 7.25%, 7.5% for investment property, I think, in most cases. So if that's too high to cash flow, find a short-term rental, find a midterm rental. There's other ways in which to accomplish your variety of variables, even in a 7.5% interest rate environment.
Well, there's so much I could say about the Fed and the direction of interest rates, but I think you said something very important earlier, that the average shelf life of a mortgage loan product is about 5 years. It's exceedingly few people, well less than 1%, that are making their 360th monthly payment ever on a 30-year fixed rate loan. Caeli, I want to ask you what maybe is becoming sort of known as the Caeli Ridge question. I like to ask you this almost every time that you're on the show because it gives us a temperature of the market. Because you see so many loans and so many appraisals come in there. What percent of appraisals are coming in above value? What percent are coming in on value? And what percent of appraisals are coming in below value?
We don't see as many low values. I think that there was a period of time where that was rampant. It was really frustrating for a lot of people, especially on the non-owner occupied side. The vast majority are coming in on point. And I think a lot of that has to do with 0809 regulation. Appraisers are kind of scared of their own shadow in overvaluating properties. So I think that they do everything they can to hit the mark. And I don't see too much over. On occasion, we'll see a little bit over. It's more likely to see it over than under these days. But I would say, okay, percentages under 10%, on the mark 80, 75, and then over, we'll give it 15.
15. Okay, a few more over than under, but pretty close to right on value there. You do loans in almost all 50 states, and these are the states where the property is located, not where the borrower lives, right? So it's every state except a few.
Right. We're not in North Dakota, and we are not in New York. Otherwise, we are lending in all 48 states where the property is. That is correct.
Yeah. And you specialize in loans for investors. Like I said earlier, what other loan types do you offer investors and others in there? Because you do a few primary residence loans too.
We do lots of primary. I would say, it's 70-30 probably. We're very capable, full service, direct lender. What that means is we fund on our warehouse line, we underwrite in-house, but we don't service these loans. So we bundle them up in mortgage-backed securities and we resell them on the secondary market to aggregators. You guys will know this as servicers. PennyMac, Wells Fargo, whoever is going to be the end servicer of the loan. And I've worked really, really hard to create an environment specifically for investors, not exclusively, but largely, so that we're not a one-size-fits-all. So I really appreciate the question and being able to articulate to your listeners, we really do everything. It's very uncommon that we don't have a loan product to feed the actual need. The one thing that I would say we don't have or don't offer is going to be bare lot loans. We don't fund on just bare land, but we can do the Fannie Freddies, bridge loans. So for the fix and flip or fix and hold, the Burr, we do non-QM. This is just non-QM is kind of everything outside the Fannie Freddie box. If you can't quite fit into the rigors of Fannie Freddie, you're going to be in non-QM, probably where debt service coverage ratio lives, bank statement loans live, asset depletion loans live. We have commercial loan products for commercial properties, for residential properties. We have ground up construction, first lien HELOCs. For relationship clients, we have second lien HELOCs. We had second lien for everybody, but we pulled back just for relationship clients for reasons that we'll discuss on one-on-one if anybody's interested in that. What am I forgetting, Keith? You get the point. There's a lot. If you think that you're trying to get financing for residential or commercial properties, please email us and we'll take some information and let you know what we can do.
Well, yeah, to my point, you provide such a great service and a wide palette of options. It's somewhat easier to describe what you don't do than what you do offer to people. And of course, I've done my own loans in there at Ridge and my own refinancings in there at Ridge. And yes, I usually end up getting a servicer that's one of the big banks that you've always heard of over the long term that I make payments to. Where does one get started to get things rolling with Ridge or just to ask some questions?
Call us, 855-747-4343, 855-74-RIDGE. You'll get to someone immediately. We don't have any call trees. You'll speak to me if I'm available at the time. Our website's got a lot of great information, ridgelendinggroup.com, email info@ridgelendinggroup.com. All of those ways will get you on the books with me if that's what you'd like, or assign you to a loan officer in the company. And we look forward to serving you.
You have given our longtime listeners more good, timely mortgage information than anyone in the history of the show here, and we're all better for it. Caeli Ridge, thanks so much for coming back onto the show.
Thank you, Keith.
Let's review some of what you learned about Burr and their loans today. Once your property is renovated and rented, which are the first and second R, the third R is refinance. For a cash-out refinance type, it is a maximum of 75% loan-to-value on single-family and 70% on a 2 to 4 unit. And then for a rate and term refinance, which means when you don't get any money in hand after closing and you're simply paying off existing liens plus closing costs, it's 80% loan-to-value on single-family and 75% on a 2 to 4 unit. And you learn to be sure that both the purchase price and the acquisition cost are listed on your final closing disclosure. You know what I think is interesting with originating mortgage loans today overall? It's one question that I've been thinking about, and maybe we'll do a poll on this question. If we do, I'll share the results with you. And that is, do people care more about the mortgage interest rate than the purchase price of the property itself? Sometimes it seems that way to me. Now, your mortgage rate definitely matters, but not as much as the purchase price. I mean, later, months or years down the road, after you purchase a property, you can often renegotiate the mortgage interest rate, like if rates fall, but your purchase price stays fixed. That part never gets renegotiated. And like I mentioned last week, low mortgage rates don't create wealth, leverage does. And to put a finer point on that, consider that in 1971, the mortgage interest rate was 7.3% back there in 1971. If you had waited for interest rates to go down, you wouldn't have purchased a home or an income property until 1993. You would have waited 22 years for rates to go down, and meanwhile, the price of real estate quadrupled. And many people expect mortgage rates to stay higher longer. Whether you're interested in the BRRRR strategy or already renovated income property or even primary residence loans, I invite you. You can get loans at the same place that I have myself for years. That's at ridgelendinggroup.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.